Hi, this is CH. This video is part of a series of videos titled My ABCs, or Absolutely Biased Comments, to share how an individual investor like you and I can try to find out more about an investment fund from public sources and do some basic research or simple due diligence before deciding to buy the fund or walk away. Do explore the other funds covered in this series and subscribe to the channel if you find this video useful. Some quick disclaimers before we start. This is not a product sales pitch or a recommendation to buy. I'm not sponsored by anyone to do this video. Please do your own research and be clear about the product features and risks before taking any action. The information shown and mentioned in this video is accurate as of the date stated here. In this video, I will be talking about the iShares US Equity Factor Rotation Active ETF that has the Bloomberg ticker DYNF. This video is done as a follow-up request from a viewer's comment in my previous video covering the HSBC GIF Ultra Short Duration Bond Fund. If you would like me to cover any funds or ETFs, do drop me a comment in any of my videos and I'll be happy to work on it as long as I can find enough information on the product. iShares has its roots from an indexing team in Wells Fargo, but properly grew after the team was sold to Barclays under the Barclays Global Investors business segment. Barclays Global Investors decided to aggressively grow the ETF business in the year 2000 and officially branded the products as iShares. iShares gained quick popularity from its original suite of equity ETFs tracking the MSCI International Stock Market Indices, as well as being market leaders to launch ETF products covering bond markets and thematic investments such as suitability and ESG. In 2009, BlackRock bought over the entire Barclays Global Investors business segment, including iShares from Barclays. BlackRock continued to expand the iShares business in alignment with increasing investor demands in ETFs and indexing mutual funds in the past decade. Today, the iShares business has grown into a gigantic market leader in the ETF space, managing over $3.3 trillion of AUM through more than 1,400 ETFs offered globally. Over $1 trillion of AUM in over 700 ETFs are listed outside of US. The iShares US Equity Factor Rotation Active ETF that is covered in this video, however, is currently only listed in US, with the Bloomberg ticker DYNF. There is a global equity version of the same strategy that has both US listed and Europe UCITS versions, but we won't be covering that in this video. Given this is a product that involves factor investing, let's do a quick 101 on what factor investing is all about. As per Wikipedia, factor investing is an investment approach that involves targeting quantifiable firm characteristics or factors that can explain differences in stock returns. It is important to note that this is one of the many investment strategies or approaches, and by no means the definitive superior way to invest. It is also a kind of an evolution from the capital asset pricing model or CAPM that theorized only a single factor in investing, that is expected return is a function of only volatility and nothing else. Factor investing relies on quantifiable or measurable statistical data. You cannot have factor investing defined using subjective views. Due to this, factor investing is most easily deployed in investment solutions using systematic approaches that relies heavily on computer investment models instead of human analysis and decisions. The definition of factors can be rather flexible, although there are a few that are popular and generally accepted as the most commonly used in factor investing. Some factors can be defined with a single data. For example, size factor is simply defined by market capitalization, while some factors are defined using multiple data. For example, quality factor is defined by high discounted cash flow with low PE and PB ratios and others. Factor investing is generally used in equity universe only, as there are more financial statistics available in the equity universe to slice and dice, while the bonds universe are more straightforward and the alternatives universe do not have enough public data for people to review. Factor investing is also commonly referred as smart beta, which means a smarter way to obtain market beta returns. BlackRock simplifies factor investing by keeping to 5 main factors that are value, quality, momentum, size, and minimum volatility or min vol. We can think of these factors as different types of filters to apply on a designated equity market in order to slice and dice the list of stocks according to our preferred filter. To put these factors in layman terms, let's use apples as an example. Apples comes in different shapes, sizes, color, and variety. Value factor is quite straightforward, and it's like choosing all apples below $1 per apple, regardless of size or variety. Quality factor is more complex. If we use sweetness to define the quality of apples, then we can perhaps choose varieties that are at least as sweet as red delicious. Momentum factor is simply going for the most popular items. If a well-known celebrity endorses Pink Lady and claims it's her favorite apple, all her fans may go buy Pink Lady apples instead of others. Size factor is also quite straightforward. For example, choosing all apples less than 100 grams before you saw a nutrition article claiming smaller apples have more nutrients than the larger apples. Minimum volatility factor goes for consistency. This is like choosing Granny Smith for baking recipes because it is the most commonly agreed to be the best apple variety for baking. Coming back to equity markets, factor investing as a quantitative approach obviously needs statistical data to support its usefulness. There have been multiple studies stating factor investing can help to deliver outperformance, and this data graph cited by iShares is one of them. Given iShares is the largest ETF provider globally, it has an ETF for each of the 5 factors mentioned above for the US equity market. These are all US-listed passive ETFs that respectively track an index that implements the associated factor in a predefined quantitative process. For investors who want to have a single solution that covers all the 5 factors, iShares also has a passive ETF called iShares US Equity Factor ETF that tracks an index with a predefined fixed allocation to each of the 5 factors. For investors who do not want a fixed allocation to the factors and prefer to rely on the expertise of iShares to assess the markets and adjust the allocations dynamically, it will be the iShares US Equity Factor Rotation Active ETF that is covered in this video. The iShares US Equity Factor Rotation Active ETF provides only a short paragraph of investment objective in its webpage and fact sheet, so we'll look at the details in the prospectus for more information on the strategy. The investment objective provides 2 key information. The first is that the ETF has a specific target that is to outperform the large and mid-cap US equity markets. The benchmark used by the ETF is MSCI USA Index, though we can also use the more popular S&P 500 Index to represent the broad US equity markets. The second is that the ETF has a factor rotation model that is really the key in making dynamic allocations to the factors, and thus is what categorizes this ETF as an actively managed ETF instead of a passive one. The ETF has a requirement to invest at least 80% of assets in US companies. The definition of US companies is quite broad though, as it can be companies domiciled in US itself, which should be the majority, non-US companies that are listed on the US stock exchange, for example, China companies that are listed as US ADRs, non-US companies with majority business in US, or any company that is included in the benchmark index. Despite this policy, I would expect the ETF to have near full investments in US companies except for a small amount in cash equivalents or liquidity needs. Otherwise, an investor might as well go for a global equity ETF instead. The 5 common factors are listed here, and the factor rotation model has a cap of 40% to be allocated to a single factor. It is also emphasized that this is really a quantitative or systematic strategy, as the ETF will generally rely on the model with minimal human intervention. There is also a bit more information on the factor rotation model, where it states the model considers information about the current economic cycle as well as the valuations and recent trends for each factor. The model can then derive long-term return premium as well as short-term returns from timing the cyclical behavior of each factor. Finally, the model prioritizes factors with the strongest near-term return prospects and overweights them accordingly. Given this is an ETF that runs a proprietary quantitative model, there are no further details available for us to try to understand the model or the strategy better. The ETF does come with a product brief or product brochure document that tries to explain the strategy a bit more. Here, it stresses the model aims to generate alpha returns or the outperformance with its dynamic allocation on the different factors. There is also a mention on risk management. However, there is no elaboration on this part of the process, so I can't comment further on it. The product brief also gives a nice illustration on the different factors that will likely do better in different market conditions through a market cycle. This is useful to give new investors a feel of what to expect of the factor investing, although this is too generic to represent the actual model in the ETF. The iShares US Equity Factor Rotation Active ETF is co-managed by Philip Hodges and Heron. Both are from BlackRock's systematic investment team, which reinforces the fact that this product runs a quantitative or systematic strategy. Philip Hodges is the co-head of Systematic Equities Macro, which is a sub-team that focuses on macro and factor optimization. Heron is a senior research in the team, focusing on research and innovation, presumably to work on improving the factor rotation model. The iShares US Equity Factor Rotation Active ETF was incepted in 2019, which gives about 6 years of track record. AUM is over 18 billion US dollars, which is a decent size for an active ETF. The ETF looks to be pretty liquid in terms of trading volume, and the premium discount gap and medium bid-ask spreads are low, which is good for investors. Historical premium discount chart for the past year to date is available in the ETF webpage. Benchmark is MSCI USA Index as previously mentioned. The benchmark is for performance comparison purposes only and has no impact on the fund strategy or portfolio. The ETF has a quarterly distribution, although the yield looks pretty low at around 1% or less, so investors looking for income play shouldn't consider this ETF. Additionally, given this is a US listed ETF, distribution payout is subject to US withholding taxes. The full distribution history is available in the ETF webpage. The ETF charges a total expense ratio or TER of 0.27%. It is not among the cheapest US equity ETFs in the market, but considering there is an active strategy involved, this is still a decently low fee. The ETF provides sector breakdown as per usual equity fund products. We can't tell much just based on this data, so let's throw in the benchmark for comparison. Putting the two side by side, we can see that there are not too much differences between the ETF and the benchmark on sector basis. The ETF has slightly higher allocations to financials, communications, and utilities, and slightly lower allocations to industrials and healthcare, but nothing that looks alarmingly different. The ETF currently has 108 holdings, and the full holdings data is available in the ETF webpage. Again, comparing against the benchmark of 576 constituents, we can see the ETF has a much smaller number of holdings, so at least the factor optimization in the ETF strategy is filtering off quite a lot of stocks. As a result, the top 10 holdings in the ETF totals to about 45% of the portfolio, compared to 34% in the benchmark. It is also worth noting that most of the top 10 holdings are similar in the ETF and the benchmark, so you are still getting exposures to most of these leading companies with the factor rotation model in the ETF. There is unfortunately no information on the factor breakdown in the ETF webpage and fact sheet. The product brief document, however, provides a glimpse of the factor positioning in the ETF relative to S&P 500 index. It is interesting why they didn't use the benchmark that is MSCI USA Index, although the two indices are not significantly different. Here, we can see the ETF is slightly tilted to higher quality, has no bias on stock volatility, quite tilted to higher momentum stocks, extremely tilted to mega caps, slightly tilted to cheaper stocks, and neutral on growth stocks. These tilts are the result of the model after assessing macro conditions and determining which factors has the highest potential returns in the near term. So what this means, for example, is that the model thinks mega cap stocks with high momentum are likely to do better than the rest. I also found a factor heat map of the ETF in another BlackRock webpage that looks very useful to explain the active changes done by the factor rotation model. So it is quite puzzling why iShares did not include this heat map in the ETF documents. Here, we can see, for example, in 2021 during COVID period, the model was extremely overweighted in small caps with little regard on quality and volatility. Then, in 2022, as the world moved out of COVID and the market went through a correction, the model kept the weights quite even across the factors. In late 2023 through to the rest of 2024, the markets exhibited strong bullishness. The model heavily overweighted on mega caps, high momentum, and quality stocks. With this information, we can then make better opinions on the performance of the ETF through various time periods to determine whether the model managed to generate alpha returns. The iShares US Equity Factor Rotation Active ETF has a dynamic performance chart available in its webpage that compares the ETF against the benchmark MSCI USA Index. The chart allows for free toggle of start and end dates, so it is useful to zoom into specific time periods if you need to do some analysis. The webpage also provides annualized, cumulative, and calendar year performance data for the ETF, and also includes the benchmark numbers for easy comparison. The only not so ideal thing is that the data is only available up to the end of the last calendar quarter. From this data, we can see that the ETF has outperformed the benchmark slightly on annualized and cumulative periods. However, this is due to strong outperformance in 2023 and 2024 calendar years. Prior to that, the ETF actually underperformed the benchmark in 2020, 2021, and 2022. Let's use Morningstar charts to do some further analysis. Here, I am using the SPDR S&P 500 ETF or SPY as a proxy benchmark to compare against the iShares US Equity Factor Rotation Active ETF. To understand how the factors impact the performance, let's add in the 5 individual factor ETFs from iShares. Here, we can see the 5 factor ETFs have very different performance track record. Quality factor is the highest correlated to SPY and the factor rotation active ETF. Momentum factor shows some competition but looks much more volatile, showing momentum play has shorter term cycles in the market. Meanwhile, small caps and value factors looks to be lagging behind quite a lot in performance as a reflection that these are not the factors preferred by investors in the past few years. Indeed, the market has been dominated by mega cap stocks with seemingly expensive valuation but still with high growth prospects, and their share prices can be volatile at times. Just think about names like Nvidia, Tesla, and so on. One important thing to gather from this performance comparison is also that none of the factors have shown the ability to confidently outperform S&P 500 over time. This means the factors may be able to only deliver outperformance for a limited time frame, and as an investor, if you miss the entry point or exit point of this time frame, you will risk underperforming the broad US equity market instead. Therefore, it is not beneficial to consider staying invested in individual factor ETFs for the long term. So what this also means is that it wouldn't make sense to create a fixed allocation to the different factors as a portfolio. iShares has provided evidence on this through the iShares US Equity Factor that, as I previously mentioned, is a passive ETF with a fixed allocation to the 5 factors. As seen in this chart, Equity Factor ETF has consistently underperformed or delivered about the same as SPY. Therefore, as an investor, there is no point considering the iShares US Equity Factor ETF at all. Comparing the two iShares ETF also gives us some insight on how well the factor rotation model works. Because in the simplest sense, if the active ETF outperforms the passive ETF, that means the model made better allocation decisions than a static allocation, and therefore generated better returns, and vice versa. Broadly looking at the performance lines in the chart, we can kind of gather that the rotation model worked from 2019 to late 2021. Then, between late 2021 to early 2023, the model seemed to have failed. And finally, from early 2023 onwards, the model appears to be working again. Let's zoom in to a shorter time period from 2023 onwards, as this is the period when the factor rotation active ETF appears to outperform SPY quite decently. Looking at this, we can gather that the model should have minimal allocations to min-vol, small caps, and value factors because they continue to show persistent underperformance versus SPY. The model should have a big allocation to quality factor through this time, but the only way to achieve the performance should be an overweight to momentum factor from 2024 onwards. Indeed, if we change the start date to 2024, we can see that the momentum factor is the only one that has outperformed SPY, so it does seem the model appears to be doing something correctly. However, the model is far from the ideal state. The model appears to be unable to make very short-term allocation adjustments or catch short-term market signals. For example, it would be great if the model can significantly overweight min-vol factor in February this year when the market and the other four factors started correcting. Or, it would be great if the model can catch the up move of momentum factor again in April. But for year to date so far, looking at the performance lines, the model appears to maintain most weights in quality factor with minimal adjustments. So there is definitely plenty of room for improvement for the model and the ETF. With that, let's summarize our findings. iShares is well known to be the ETF market leader and is part of BlackRock, the world's largest asset management firm. There is no doubt in the resources available for iShares to continue innovate to create new investment product ideas and improve existing ones. Factor investing has been popularized in the past decade with the rapid growth of related ETF products in the market from providers like iShares. Some factors do appear to perform better than others over time. Therefore, having an active strategy to rotate among factors is potentially a good idea, as market timing is a key consideration for factor investing. Given this ETF runs a quantitative strategy and uses a proprietary factor rotation model, there is very limited information available on the model, and therefore it is difficult to assess the effectiveness of the model. The performance of the ETF since inception has been mixed. The ETF underperformed in 2019 to 2022 relative to the benchmark, decently outperformed in 2023 and 2024, and looks to be on par with the benchmark year to date. As such, it appears the model seems to have gotten better from its earlier days, but there is certainly still more room for improvement. In conclusion, the iShares US Equity Factor Rotation Active ETF is an interesting product for investors who prefer to rely on an active solution to determine the factor allocations rather than going hands-on to market time individual factor ETFs. At this point, I think the track record of the ETF is still a bit short, and there are definitely areas where the model can be improved. Therefore, investors can perhaps consider using this ETF as a complement to core US equity exposures for now. This concludes my absolutely biased comments on the iShares US Equity Factor Rotation Active ETF. Again, if you find this video useful and would like to see more related contents, please subscribe to the channel. Thank you and have a great day.